Which is the best high yield dividend stock to buy right now? Is it Verizon Communications? Is it Chevron Corporation? Or is it 3M Corporation? I'm going to answer that question in this video, comparing the three dividend stocks on four financial metrics, starting with the dividend yield. So let's begin. So looking at the three companies' dividend yields, starting with Verizon, you have a dividend yield of 6.61%, the highest among these three dividend stocks. Next, you have Chevron at 3.43%, the lowest among these three dividend stocks. And finally, you have 3M Corporation with a dividend yield of 5.84% in the middle of these three dividend stocks. Now, remember, when you're buying dividend stocks, it's not just the dividend yield you're getting. You also own the stock and you're exposed to fluctuations of the stock price. So while you might get a dividend yield of 3, 4, or 6%, the change in the stock price might supplement that dividend yield. In other words, make your overall total return higher, or it might work against you and the stock price might fall, thereby taking away all or more of the yield you get from the dividend. So it's important not just to consider the dividend yield, but the potential for the stock price to increase or decrease. And that's why I'm going to look at these next three metrics in addition to the dividend yield. So the first one of the next three I will look at is quarterly revenue growth. And looking at this metric, you see Verizon with relatively stable and low revenue growth, ending with 3.48% in its most recent quarter. And this is just about what investors can reasonably expect from Verizon going forward over the next several years. The market it operates in is saturated, right? You're not getting very many new subscribers to cell phone services, right? Or wireless internet services. What you're getting is customers changing services, switching services. But the area for growth for Verizon is going to be incremental devices. Right now, most people have a cell phone, a smartphone, but the market for smartwatches is not as saturated as smartphones, and the market for tablets getting connected to wireless accounts is not as saturated as smartphones. So Verizon can find growth by adding those incremental devices onto customer accounts, thereby increasing the monthly revenue they gain from customers. That's where Verizon will grow over the next several years. Chevron Corporation, the fastest growing stock in out of these three recently. As you're all likely aware, oil prices have surged higher following the Russian invasion of Ukraine that roiled energy markets worldwide. Chevron has been a beneficiary of that trend, and revenue increased 18.89% in its most recent quarter. This does not look like it's going to end anytime soon. So investors can expect revenue from Chevron to continue growing at healthy rates, especially since OPEC, the Organization for Petroleum Exporting Countries, recently announced that they will be cutting oil production. So supply is decreasing in the market. So is to prepare for a potential decrease in demand if there is a worldwide economic slowdown. That slowdown in demand for oil is offset by even more decreases in supply. And finally, 3M Corporation revenue decreased 6.19% in its most recent quarter, and the company is in the middle of litigation, and the outcome of that court case can potentially impact 3M investors significantly. So that's also something to keep an eye out for regarding 3M. The next thing I wanted to consider is these companies' profit margins, their net profit margins, the bottom line. net income as a percentage of revenue. And I pulled this metric going back 10 years. And looking at this, you see that recently they're all very close. 16.88% for the highest, 3M net profit margin, 15.5 for Verizon, and 15.05 for Chevron. They're all very close together. The most stable is 3M, and the wildest fluctuations is Chevron, which is to be expected because Chevron experiences tailwinds and headwinds from changing oil prices. So when oil prices fall, that's a headwind for Chevron. Profit margins fall. And when oil prices rise, that's a tailwind for Chevron and profit margins rise. So it's more volatile, it's more cyclical than the other two stocks, which are more consistent and more stable. And finally, I wanted to look at valuation, and I chose to use the forward price to earnings ratio. Looking at this metric, you have Chevron at a forward price to earnings of 11.77, the most expensive out of these three. Then you have 3M at a forward price to earnings of 10.79. Finally, you have Verizon at a forward price to earnings of 8.3, the least expensive out of these three dividend stocks. So if I had to pick one of these three dividend stocks to buy right now, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would pick Verizon. I would pick Verizon for the reasons I mentioned earlier. The company's got a more stable customer base, and it has an opportunity to incrementally add devices onto consumer services, increasing the revenue and profits longer term. Also, in the event of a recession, Verizon is more protected than Chevron and 3M because one of the last things people will cancel is their wireless internet service, right? So if you lose your job, you're not going to be driving as much, and multiply that by the millions of people that might lose their jobs during a recession, and Chevron is more exposed to that downturn, whereas Verizon, not so much. And then 3M, I highlighted the court case earlier, so that might be a negative outcome. That's making me a little bit less enthusiastic about 3M while it's still an excellent stock. So that leads me to choose Verizon as my favorite dividend stock out of these three to buy right now. All right, that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership. There's a lot of things you could be doing right now, but you're watching this video, and I really appreciate that. Thank you so much, and I hope you'll tune in again next time.